segment. Karan Bhagat is the founder, managing director and CEO at IIFL Wealth and Asset Management and now joins in on the show to discuss that and lots more. Good to have you on board, Karan. To begin with, we have seen a lot of deals within the wealth management space, the most recent being the PAG deal of Edelweiss Wealth Business. What's your outlook on the prospects of the Indian wealth management industry over the next 5 years in terms of the opportunity size?
Thank you for having me today morning. I think from a wealth management industry perspective, India is blessed in having immense amount of tailwinds. I think if you look at the broader wealth management industry, and we kind of tend to classify it into three different segments. The first segment being the mass affluent segment, which typically would range between the 10 lakhs to a crore. Secondly, the priority segment, which would be somewhere between the crore to 10 crores. And the last, obviously, the ultra high net worth segment, which would be the 10 crores and upwards. I think we're seeing a tremendous amount of growth in all three segments. We are also seeing a flurry of capital markets activity, not only for the last 3 to 6 months, but potentially for the last 10 to 12 years. Every quarter, we see businesses being either disinvested, sold, or promoters essentially ending up with a partial payout in terms of a monetization event. We also see a huge number of professionals who become the new word, so as to say, is the professional entrepreneurs, who have ended up creating a lot of wealth through stock options over their journey of being professional CEOs. And lastly, we've seen industrialists who over a period of time may not have monetized their business, but through dividends over a period of time have created a financial asset portfolio distinct from the business operating portfolio. And fourth, obviously, your sports people, actors, lawyers, if I can call them professionals in that sense, who have also ended up creating a good pool of capital for themselves. So I think these are the four different types of investors we typically end up dealing with. And it's fair to say that the tailwinds and the growth in the economy over the last decade is aiding the growth of wealth managers for sure. That's on the size of the market. I think the second thing which is really kind of helping us grow is the entire education around why use wealth managers, right? The entire process and science around managing wealth, the ability to construct an investment portfolio mandate, to make a process and science about managing wealth as opposed to making sporadic decisions is something which clients are willing to appreciate, and hence it's soon becoming a very focused industry. The regulator has also taken some great steps. We've seen SEBI come out with the advisory guidelines. There's substantially much more clarity on the broker-dealer guidelines. There's more clarity on the portfolio management guidelines. And in some ways, the ability of the investor to deal with us on a fiduciary basis has improved substantially. So overall, I think the size of the industry, the sophistication and the knowledge of all of us wealth managers, and lastly, the regulatory framework, all three have improved substantially over the last decade to enable the industry to grow.
Okay. And Karan, you've been one of the reputed wealth managers. There's a large book size as well that you manage, about 2 lakh crores. What is the overall market share that IIFL Wealth enjoys? What kind of AUM growth are you pegging over the next 3 years from the current size of 2 lakh crores?
The business is very difficult to compute because extremely fragmented business, and the AUM is a strong combination of assets under advice, portfolio management, assets under custody. But I think if I look at market share just in terms of the number of high net worth individuals we are able to service, I think we would be somewhere between the 2.5%. So it's not actually a large number. Our estimate is in the ultra high net worth segment, there would be around about close to 3.5, 4 lakh, or maybe 2.5, 3 lakh families today who would fit in the bill. We would be servicing 4.5, 5,000 ultra high net worth families across the country. So I think our market share, both in terms of AUM as well as in terms of penetration, would be 1.5 to 2%. Having said that, the overall market which wealth managers are able to capture seems to be less than 20% of the overall AUM from these clients for multiple reasons. And within the wealth management market, maybe our market share is between the 8 to 12% number. So that's really what I think in terms of our market share.
Karan, while the opportunity is huge when it comes to wealth management, there are only very few focus players in the market right now. What is your own growth strategy at IIFL, and what are the focus areas really for the business, say, for the next 3 to 5 years?
So I think wealth managers broadly can be divided into three varieties, and each has a role to play in that sense. The first, obviously, are the bank-sponsored wealth management firms, where essentially the core activity is obviously the banking part of the business, the current account, savings account, and the wealth management business really represents the fee income part of the business. Second would be obviously large players like us. Some of us would have NBFC licenses, some of us wouldn't. But our core activity will be managing money, and 60 to 70% of our revenue lines and potentially 95% of our time would go to manage money. And third would really be your independent financial advisors, who would pretty much fit in the same bill as the second one, except for the fact that they'll be much more pure advisory in nature, as opposed to kind of having access to a full platform. In terms of growth for our own business and the industry as a whole, I think we've got a very good opportunity to, in spite of having a high base of 2 lakh crores, to be able to grow at 7.5-8% net AUM growth every year, and therefore add close to around about 12 to 15,000 crores of assets every year. But most importantly, potentially add another 500 to 600 families every year. I think both the numbers are important because at the end of the day, the AUM is only a function of the number of clients you can add. So I think we love to track both numbers. And I think obviously as the business goes along, we are naturally blessed to be benefiting from the mark-to-market increase in the AUM. So we've seen typically the AUM, on a constant basis grows at 6 to 8%. Obviously, there are years where it comes off, and then there are years which it grows exponentially. But in terms of mark-to-market, but the steady growth in mark-to-market because of the growth due to change in values itself is 6 to 8%, and we hope to be able to add 6 to 8% through acquisition of new clients. So overall, I think we would like to believe at least for the next 3 to 5 years we're able to grow our AUM by a clip of around about 15% every year, and that I think would be healthy for the industry. Obviously, the newer players, some of them may be able to grow by 20-25%, but I think overall the industry is set to grow by 25-30% a year, even from here.
We've had a stunner of a post-budget rally, and from there, this, new irritant called the US bond yield has brought about a fair amount of volatility, and of course, inflation concerns, fears of a taper tantrum coming in from the Fed, and our own, markets which are worried about inflation, given the kind of escalation that you've already seen in commodity prices. If someone had to come to you right now and say that for the next 1 year or 2 years, here's a sum of 1 crore, how is it that you're going to allocate it? What's going to be the asset mix?
So yeah, I think depends on investor to investor. It can't be absolutely uniform, but I'll kind of let's take the most representative investor in our firm. A person who's moderately aggressive, for the lack of a better word, and take you through the allocation for that investor. So I think of a crore, around about 60% would be in equities for the long term, 40% would be in fixed income. Of the 40% in fixed income, I think 75% would be in the AAA sovereign bucket, 25% would be in the AA plus, and maybe 5 to 10% in the structured bucket. All of these three things put together would typically end up at a return of around about 7.5%. So this is the boring part of the portfolio, the 40%, which effectively kind of yields 7.5%. The 60% part of the portfolio, which is on the equity side, is kind of broken up into two parts. Nearly 85% of that, which is 50%, essentially goes into listed equities. Around 10% 80%, which is 15%, essentially goes into alternates. If the client has the ability to kind of hold it out for the next 3 to 5 years. On the first 85%, the big elephant in the room is obviously how to allocate that 50 rupees into equities over the next 1 year, given the levels of the market and some of the points you made in terms of interest rates, the elevated levels of the market. So there we follow a fairly simple scientific method. So if an investor has to allocate 60 rupees into 50 rupees into equity, at all points of time, we typically don't go below 60% of that allocation. So effectively, we would look to reach and invest round about 30 rupees in a systematic way over the next 6 to 12 months. So on the 30 rupees, we will be potentially putting in 2.5 rupees every month for the next 12 months. The remaining 20 rupees, we would be a little more tactical about. And we use two methods of combinations of price to earnings and price to book to be able to estimate whether we want to be invested 60% or 100%. And it's not as if this gives you a clinically right result given the liquidity in the market. But for example, on a PE and a PB basis at around about 13,000, 1,800, 14,000, on a 50 rupee equity portfolio, we would be down to around about 30 rupees invested and sitting on 20 rupees cash. So currently, if you ask me, we would, of the 100, if somebody was to give a crore, around about 40 lakhs would go into debt, 10 to 15 lakhs in a slew of alternates, including private equity, early stage structured credit. Of the remaining 50 lakhs, 30 lakhs would go into cash in an SIP format over the next 6 to 12 months. And for the remaining 20 lakhs, we would wait for the markets to come down below 13,800, 14,000 for us to add progressively to the portfolio.
That piece of advice and wisdom, Karan, great to have you on the show. We'll let you go on that note. Good speaking with you as always.
Thank you. Thanks a lot. Thank you.